Hello everyone, welcome back to Just Invest Today, and in today's video we're talking about a value investing edge that we have as investors. This is super key because a lot of people think that we have this incredible analytical edge over all the computers and all the Wall Streeters. Maybe you have the best DCF model that can kind of beat out anyone, whatever it is. In this video, Mohnish Pabrai is going to break down the real edge that we have as value investors. But before we get into the video, guys, please like it and subscribe to my channel. You have to look at this chart because we have stocks like Baba down 70+%, JD.com down around 65-67% from peak to trough. We have Tencent down at 70% as well. And people are like, damn, how are you still holding on to these companies? You're down probably like 20-30% overall. But guys, if you're actually looking at the true value of the business, we know that in 5 years, these businesses are still going to grow, and they're growing right now. We have the cloud segment growing in Baba. We have even the retail segment growing in Baba. We got JD.com. The retail sector is still growing there. The third-party marketplace still growing. They have logistics services growing. We have Tencent. The advertising business is still growing inside the company, but it doesn't matter right now because you have to understand the investment horizon. So let's look at this chart and break it down. Chris Mayer actually posted this chart on Twitter, and it's a perfect example of what we're looking for as value investors. This chart basically explains what drives your investment results. And it just goes to show you what really drives your investment results, and the time frames that you're looking at is super key to your investment results over time. And this is why Peter Lynch has always said that he's made his best money in the 5 to 7 years. This is all about reinvestment in earnings and people and culture. Let's get into what drives your investment results. First quarters, it's all about sentiment change, 1 year, multiple change, 2 to 5 years, cycle in industry. And that's what we're dealing with Alibaba. The cycle right now for Alibaba is I hate China, I hate the industry, but that doesn't matter in the 5 to 10 years. It's all about reinvestment. What are they earning on the capital that they're allocating? How fast is the company growing? Are they growing their earnings, their revenue, return on capital, all of that stuff? 10 years, people, and culture. And we know that Alibaba, Tencent, JD.com are so strong on culture that this is what we really have to look for. So we're looking at the time horizon of our plays. Right now, we're all into the multiple change. Alibaba, Tencent, JD.com are at the lowest multiples ever. So that just goes to show you what's happening in the market right now. But if we're looking at the 5 to 10 years, we can see that reinvestment is what really matters. Now let's get into this Mohnish Pabrai interview, how he breaks this down, the true edge of value investors.
Yeah, so one of the arrows in our quiver as value investor is patience. So in general, we don't really have the most part in information. So if I'm looking at a business, there's not much I'm going to be able to come up about that business that a lot of other people haven't figured out or are capable of figuring. So the information edge, for the most part, doesn't exist. Then there can be another edge, which is analytics. Two individuals have the same information, but one person is able to look at that data and come to conclusions that are different from the other person. So an analytic edge can be a real edge. But even that is difficult because our company. The one edge that is probably the strongest is the time horizon. And even Jeff Bezos says that a lot of his competitors are focused on the next 1, 2, or 3. And he said that Amazon always took the approach of looking out longer, looking out 5 or 7, 10 years. And he said that when they looked out longer and they invested with that longer time horizon, they got an edge. And they were willing to make investments where they knew that the payoff is not going to come in 3 years. So I think, yes, the ability of an investor to think longer term, and this is one of the reasons why index does so well. The index is too dumb to know that it owns Microsoft. It's too dumb to know that it owns Alphabet. And it's too dumb to sell these things. And it keeps these things endlessly forever. Look at the S&P 500 index, for example, which is 500 for the most part great business. And every year they might take one or two businesses out and replace them with one or two new ones. But usually the ones they take out are not the ones that are climbing. Like recently they removed General Electric from the Dow Industrial Average. And if you look at the Dow Jones Industrial Average over time, in general, you get rising stars going in, and you get kind of companies that are kind of long into asset prime being taken out. The S&P 500 will hold an Apple or a Microsoft or an Amazon or Alphabet for 20 years, 30 years. And that type of holding period on these great businesses can be a great edge.